I mean, interest rates are like gravity in valuations. I mean, if interest rates are nothing, values can be almost infinite. If interest rates are extremely high, that's a huge gravitational pull on values. And we had that in the early 1980s.
Warren Buffett has always said that interest rates are like gravity on stock prices. The higher that interest rates go, the stronger the gravitational pull downwards on stock markets. So at a time where Jerome Powell and the Federal Reserve are raising interest rates at the fastest rate they have in decades, it's no surprise that many investors are quite fearful of what that could mean for their stock market investments. And although what Warren Buffett says about interest rates having a strong gravitational pull on stock prices, I think a lot of people fail to understand or perhaps misinterpret exactly what type of impact that interest rate changes can have on particular types of stocks, because there are different stock market investments that will be far more exposed to increases in interest rates than other stock market investments. And in this video, I want to walk through why interest rates have such a bearing on stock prices in the first place, as well as go through the mechanics of why some companies in the stock market will tend to be more exposed to increases in interest rates than other companies. So if you enjoyed this video, be sure to give us a thumbs up and also click subscribe so that you can see future content as soon as it goes live. Now, value investors like Warren Buffett and Charlie Munger have made fortunes by buying companies, whether that be in private markets or in public markets through stocks, by buying companies at below what they would call intrinsic value. Now, intrinsic value is more or less just what a company is worth. If you understand all the facts about the company and you have a willing buyer and a willing seller in, for example, a privately negotiated transaction, and you come to some sort of fair agreement on what you think that business is worth, that is basically intrinsic value. And intrinsic value in privately negotiated transactions or in things like buying real estate tend to be pretty well understood. People tend to know what their house is worth, for example. But in stock markets, prices tend to be substantially more volatile. If you look at the average 52-week range in pricing on a particular company, there is a huge spectrum in prices that you could have bought or sold that company for. And that's the reason that Buffett has been so successful throughout his career, is he understands what intrinsic value is likely to be for companies that he's very familiar with, and he's able to take advantage of buying into those companies when the stock market offers him a very low price relative to that intrinsic value. Now, one of the most important parts of intrinsic value is basically understanding what your alternative investment options are. And one of the things that has quite a big bearing on your alternative investment options is interest rates. And basically, the theory is quite straightforward. If you can get a very high return by taking little risk, say leaving money in a bank account or buying something like a government bond from the US Treasury, you can basically take very little risk and get a certain return. And that return that you can get as sort of a risk-free rate is heavily influenced by interest rates. So if you can get a much higher return by taking lower risk, then there's less incentive for you to go out and invest in sort of risk assets like stocks or like real estate, for example. And that is really one of the core reasons why, as interest rates rise and as Jerome Powell and the Fed increase interest rates, there is more of a gravitational pull downwards on stock prices, because there's less incentive to take a lot of risk. You can get a better return as interest rates go up by taking basically no risk and buying a treasury bond or leaving your money in a bank account, for example. If historically you could earn, say, 8% in a stock market investment, but a treasury bond with very little risk is only paying you, say, 2%, there's quite a lot of incentive for many people to go ahead and invest in stocks, take a little bit more risk, and potentially get a higher return. But as that risk-free rate climbs to 3 or 4 or 5 or 6%, the incentive to take 8% in the stock market is much lower. And in order for you to want to invest in stocks in the first place, you might push your hurdle rate or your threshold up to maybe 10% or 12% or 15%. And for you to earn those higher rates of return and have a higher hurdle rate, basically the price of a business or the price of a stock needs to come down. A business like Apple, for example, or like Meta, or like Google, only produces a certain amount of cash as sort of a yield that you get as an owner of that stock each year. So in order for you to generate a higher return with the business not necessarily making any changes, you have to pay a lower price for those stocks. And that difference between what you can earn taking very little risk in something like a US government bond and the return that you can generate by taking more risk and investing in a stock, that difference is often referred to as the risk premium, which is basically a fancy way of saying that if I take more risk, generally speaking, I want to earn a higher return. Now, the calculation that most investors will use in order to go through this process and figure out what they're willing to pay for a company in order to earn a certain return is often referred to as a discounted cash flow. Now, a discounted cash flow is basically going through this sort of mental exercise. It's saying, if I want to buy into a particular company, let's take Apple or Google as an example, I expect that as an owner of that company, which is what you are when you buy shares in the stock market of one of those businesses, I expect that Apple or Google will generate a certain amount of cash for me every single year. And hopefully in the case of those businesses, that amount of cash produced is growing over time. And I want to come up with some sort of intelligent price to pay for those future cash flows in order for me to still generate a nice return. We also have to understand that a dollar generated today is not as valuable to us as a dollar generated next year or the year after or the year after that. If we have to wait around for Apple to produce a dollar, we have to basically put a discount on those cash flows, and that is what a discounted cash flow is all about. So, for example, if I offered you a dollar today or a dollar in 10 years, you would most likely say that you'd rather have the dollar today because there's no benefit to waiting around. But if I said you can have a dollar today or you can have $100 million in 10 years, there's quite a bit of incentive to wait around, and I think probably most people would pick the wait 10 years and get $100 million at that point. And somewhere between those two hypotheticals of waiting to get a dollar in 10 years or waiting to get $100 million in 10 years, there's sort of a tipping point for different individuals in terms of when it starts to make sense for you to wait around for those future cash flows. And that tipping point is very strongly impacted by interest rates. In a discounted cash flow formula, it's called a discount rate. So let's run through a few kind of practical examples of how that might look and how increasing interest rates and having to increase that discount rate actually impacts the value of different stock market investments. Now, firstly, here is an example of a business, hypothetically, that produces $1 in free cash flow for their owners every single year. And let's say that for you to buy into a business, you want to earn a 10% annual return. So you would put something like a 10% discount rate into your discounted cash flow. Now, the screenshot here will basically show you what those cash flows out into the future are worth in today's terms. So that $1 received in year 10 is the equivalent really of me only getting about 39 cents today. It's quite a bit less valuable to me because I have to wait around in order to receive that dollar. Now, as interest rates go up and I have more opportunity to earn higher returns by taking less risk elsewhere, what people will often do is they will go through and say, well, actually, maybe I want to move my hurdle rate from 10% a year to, let's say, 15% per year. And if we run that same discounted cash flow where we have a business that produces $1 in profits every single year, you'll notice that those future cash flows are worth substantially less than they were in our 10% return scenario. That dollar received in year 10, for example, that was previously worth the equivalent of 39 cents to us today, is now worth the equivalent of only 25 cents to us today. And these scenarios become even more interesting when we're looking at businesses that are actually growing very fast. We have a lot of people right now that are very interested in technology type businesses or software businesses that are growing very quickly, and really a lot of the value of those companies isn't necessarily in the cash that they produce today or next year or the year after that, but rather people are looking out 5 or 10 years. And they're looking at what kind of profits could this business generate when it's had enough time to go through a substantial amount of growth. And those investors will be going through the exact same calculation I've just described, where they will want to put a value on those future cash flows and kind of convert it to today's terms, because they still have to get paid a reasonable return to wait around. But the way that a discounted cash flow works is it basically has a much more significant impact on those later term cash flows than it does on nearer term cash flow. And it means that the intrinsic value for these faster growing businesses is much more heavily impacted by adjustments in interest rates. So this time, if we take the example of a business that again produces $1 a year in cash flow, but that $1 actually grows at a compounded rate of about 15% per year. This is what the cash flows look like in green, and if we discount those cash flows back and say that we want to earn a 10% return, in sort of today's terms and present value terms, you'll see the equivalent cash flows here in blue. And basically when investors are looking to buy into these businesses, they're tallying up all these annual cash flows in present value terms and coming to an estimate of what they are willing to pay for those future cash flows and for that business. Now, if we bump that hurdle rate up again to say 15% to represent higher interest rates and better investment alternatives that we now have available by taking less risk, you'll see that there is a huge impact on the present value of the cash flows for that same business. That year 10 cash flow, for example, that was previously worth $2.39 to investors is now worth only $1.53. Which is a huge change, and it's one of the reasons why, as interest rates have started to come up, the businesses that have been most affected in the stock market tend to be the really fast growing ones. Now, there's one other really big reason why stock markets don't tend to like rising interest rates, and that reason is basically debt. If a company borrows money, their repayments on that debt tend to go up as interest rates go up. And that can really eat into the cash flows of the companies that have tended to borrow a lot of money. And that can really create this sort of two-pronged negative impact on the intrinsic value of those businesses that have borrowed a lot of money. In the first case, you have people using higher discount rates, and it tends to pull down the intrinsic value of those future cash flows for the business. And secondly, you have the actual cash flows also coming down because more of the cash that the business generates tends to have to go towards interest expenses. So I hope that video wasn't too grim, but it did give you a good understanding of how interest rates can impact stock market investments. When markets are volatile, it can be a great opportunity to buy into really good businesses at phenomenal prices and at discounts to intrinsic value, but interest rates do have a genuine impact on that intrinsic value, and I think it's something that is really important to understand. So if you did enjoy the video, please hit like and also subscribe to the channel if you are new here. But that's it from me for this one, and I'll see you in the next video. Cheers.